Welcome to lecture 6 on risk management and insurance. In this lecture, we first explain short selling, and then we turn to the pricing of forward contracts. In a short selling operation, you sell something that you don't own. So you borrow an asset and you sell it. Here at time small t, and then later you buy back the asset and you return it to the original owner. Now, if at this later date the price of the asset is lower than the price here when you sold the asset, so you can buy it back here at a lower price, then you make a profit. So you can use this for speculation. If you expect that the asset prices will fall, then you short sell them, and and if you are correct, then in the future you can buy them back cheaply, and you can return them to the owner, and you make a big profit. But naturally, there can be also a loss. If the market turns against you, you have borrowed the asset here, you sold it at some price, and now here later the price is higher. So then you have to buy them back at a higher price, and because you must return the asset. And then you make a loss. So it's really speculation if you do this operation, and you can make either profits or losses. You can do this with almost any type of asset. You can do it with bonds, you can do it with shares, you can do it with commodities like oil or wheat. You also can do it with currencies, maybe US dollars or yen. Now here at time small t, when you sell the borrowed asset, then naturally you receive cash. And this cash then can be put at interest here during this time period. And in the end, you need cash to buy the asset back. Short selling is equal to holding, it's equivalent to holding a negative amount of an asset. So you cannot just use it for speculation, you also can use it for hedging. And I make it here an example of a market maker. Market makers are dealers or brokers, and they sometimes hold some securities, maybe bonds or shares, to be able to fulfill orders of their clients. So a market maker, a dealer or broker may hold securities for a short time period, maybe a few days. This involves risks. And so to get rid of this risk, the market maker can short sell the security. So he has his positive amount of securities, and then here he has the negative amount of the security, and the two positions cancel out. So the market maker gets rid of his risk. So if the price of the security falls over those few days here, then the market maker loses money on securities, but gains money on the short position. You see, if the price of securities falls, then in the future, the market maker can buy them back at a lower price. And so here on the short positions, the market maker gains money. And this gain offsets the loss on the security holdings. That's usually very short term, so market makers hold those securities maybe for a few days. Now let's go to the pricing of a forward contract. And I do it here for a non-dividend paying stock. This is a bit easier. And if you're really interested, you can look up for a dividend paying stock, you can look it up in the textbook by Hull, which I've cited. Now, we have equation 36 established a relationship between the forward price on an asset and the spot price. The spot price is a price for immediate delivery. So for example, if you go into a grocery store and you buy milk and bread and potatoes, whatever, you get those goods, those commodities, you will get immediately. That's a spot transaction. And you can also buy shares, spot bonds, you can buy them spot, then you get them immediately or almost immediately. With shares, and it depends, maybe you get them 1 day or 2 days later, but that's a spot transaction. And here we have the spot price for a share or a commodity, and here we have a forward price of a share in the commodity. Forward price, so that may be for delivery in 90 days or maybe in half a year's time. And they are related, forward price and spot price. And you see here, actually the forward price just is simply equals a spot price plus interest. Okay, so here you compound interest for the time of the forward contract, which be maybe 90 days. So simply apply compound interest here to the spot rate for the duration of the forward contract, for the lifetime of the forward contract, and then you get the forward price. Now, if this equation does not hold, you have riskless profit opportunity. And that's what you do with arbitrage. Arbitrage tries to exploit riskless profit opportunities. Arbitrage, just you try to buy cheap and sell expensive. And if it's riskless to do this, then we speak about an arbitrage opportunity. So in a broader sense, it may also apply in international trade. So maybe you buy wheat in Australia and you get it cheap in Australia, and then you sell it expensive in Saudi Arabia, okay, where the wheat is more expensive. And you actually benefit from the difference in prices. Now, if it's completely riskless, then we really speak of arbitrage opportunities. Now, wheat buying and selling maybe not completely riskless. Maybe you have problems with the transport and so on. Let's assume what happens, or let's show what happens when the arbitrage condition does not hold. So we said, okay, buy cheap and sell expensive. So here you will borrow money and you will buy, as I said, spot. Let's assume you don't have the money. So borrow the money and buy, as I said, spot. And then for immediate delivery, buy it in the spot market, and then to get rid of the risk, sell it in the forward market immediately. So buy, as I said, spot, and to get rid of the risk, immediately sell it forward. Buying spot is cheap, selling it forward is expensive, so you actually make money here. And it's riskless because you have now covered your risk. You see, you have the asset, you bought it spot and you immediately sold it forward, so you have no risk involved here. Here on the right side, what you have is a spot price plus interest, so that's just basically your financing cost. You have the spot, you apply the interest rate for the time of the contract, and so you just have here the financing cost, and the financing costs here are less than what you earn in the forward market when you cover your risk. Now, if a lot of people notice this arbitrage condition and they do this, then a lot of people buy spot. This will drive up the spot price. And then if a lot of people sell it forward to cover the risk, those forward sales will drive down the forward price. So the arbitrage condition will move toward equality. This price is driven up, S is driven up, and F is driven down. And so the arbitrage condition establishes itself automatically. Now let's assume, or let's show what happens if we have, if forward price is less than the spot price plus interest. So here you would like to sell it spot. You see you sell expensive and you would like to buy it forward, buy it cheaply. Okay, here forward. Now you may not have the asset, so borrow it and sell it short. And so you have the risk because later you have to return it, the asset. So cover that risk, buy it immediately forward. But buying it forward is cheaper. So by covering this risk here, it's become risk-free, and again you have here a profit opportunity. By selling it short, you get more than by buying it forward and covering the risk. So it's again a riskless profit opportunity, and if a lot of people do it, a lot of people sell it short, then the spot price will fall, and a lot of people buy it forward, so the forward price will increase, and so again we move toward the arbitrage condition. So arbitrage means exploiting riskless profit opportunities in the market, and it means just buy cheap and sell expensive. Okay, when there are riskless profit opportunities. So arbitrage establishes this relationship between the forward price on an asset and its spot price. Now let's go now here to let's move to the price of a forward contract. What is the price or value of a long forward contract with delivery price K? Now, when you write the contract here at the beginning, we said the contract has no value. It and that's why no money changes hands. So at the beginning, the contract has no value, but later, during the life of the contract may get positive or negative value, depending on movements in the market. So that's what I have here. When the forward contract is being written, the delivery price is set equal to the prevailing forward price, K is equal F, and so the contract has no value at that time, and no money. There's no need to make a payment. No money changes hand at time small t. So F is equal K, and we get here a 0. But later, the forward contract may actually have positive or negative value. It depends on the movement of F over time until maturity. Also, the interest rate may change. And naturally, and also the time changes. So from here to here, forward prices may change, interest rates may change, and that shows up time changes. The interval gets smaller and smaller, the remaining interval. And this, so F changes, the interest rate may change, the interval gets smaller. So this will change the value of the forward contract. Now, the forward contract is just a gap between the value of the forward contract, is just a gap between the forward price and the delivery price that's locked in here. So if the forward price goes up and up and you have locked in a low price, then naturally it looks good for you. And your forward contract okay, gets positive value. And because this happens here in the future, then you have to discount this. Because this expiration of the contract takes place in the future. So the price of the forward contract is given by the difference between F and K. When F increases over time, then your contract gets positive value. You have locked in maybe For oil, you have locked in $40, but now the oil price is $50, so you can still buy it cheaply. So that looks very good for you. You have here a positive payoff, and so the contract will get a positive value. And because this benefit arises when the contract expires at time big T, you will discount this here by the time until maturity. Now here you can use now, for F, you can use the arbitrage condition from before, write SE. I'm just using this arbitrage condition, F is SE. So F plug in SE. And then you can multiply the E into it. So I get E to the positive power times E to the negative power. So that cancels out. Just simply getting here an S. Get an S here. And here you have then K times E when you multiply the E into it. So I have here K times E. So you can also write down the formula like that. So again, when the forward contract is being written, F is equal K. We set the delivery price equal to the prevailing forward price. And so we have here 0. And so there's no need for money to change hands at the beginning of the contract at time small t. But later on, F will change over the life of the contract, depending on market conditions. Also, the interest rate will change. And naturally, also the time interval gets smaller and smaller. And so the contract may get a positive value. But the contract also may get a negative value. That happens when F over the time of the contract falls. Let's make an example here. Let's look at the forward contract that has been written 2 months ago, and the remaining life of the contract is another 6 months. So that's an older contract that already has been written earlier. We have now a remaining time interval of 6 months. The stock price currently is 25. That's the spot price of the stock. The price written into the contract, the K, is $24. And the interest rate in the market is 3%. So with this information, we can calculate the forward price. Just use the arbitrage condition. Spot price times interest rate gives you the forward price. So the forward price must be $25.38. So they usually are pretty close together. 25 and 25.38. And the value of the forward contract, I'm using here this last formula here. Okay, the spot price is 25. The locked-in delivery price is 24. Okay, so the value of the forward contract is $1.04. So in this example, the forward contract today has a value of $1.04. Maybe let's write this down again with a timeline. So we have here time small t. We have here time big T. The contract runs for half a year, 0.5 of a year. It does not matter that the contract actually has been set up 2 months earlier. Okay, so that's here really the contract was established. But we look now just at the remaining lifetime of the contract. When the contract was established, its value was 0, remember? But now market conditions have changed. And so the spot price is now 25. We have locked, here's the spot price of the share is 25. And we have locked in the contract 24. We are entitled to get the share at 24. This has been determined here when the contract has been written. So it looks actually good for us. We get here the share cheaply in the future. Already now the share is 25, so that looks good. And so this contract has a positive value. It's valuable to us. So it has here a value of $1.04. But naturally, the market could have moved against us. If at this point here, maybe the share price is only 22, then the contract would have a negative value. Then we would have to pay 24 here in the future for something that today has a value of 22, and that doesn't look good. Okay, so so the contract would have a negative value. Okay, let's remove this again. Okay, that's not yet completely. So the forward contract here has a positive value because the current spot price is high. But the contract could also have a negative value. And if you own those contracts, the outstanding forward contracts, their value should actually be included in balance sheets of the firms. They should record that. Okay, that's about the forward contracts. Now we can also explain this by looking at make an argument about cash and carry. Let's suppose an investor would like to have an asset in 90 days time, T minus T is this time interval, and you can do this in two ways. You can buy the asset forward, and then it will be 90 days, and then it will be delivered to you in 90 days. And you will pay the forward price. But you also can buy the asset spot and simply carry it, put it on storage for 90 days. Then you also will have it in 90 days. This looks easier. Just if you would like to have an asset in the future, you can buy it and put it on storage, carry it, but you can just buy a forward contract. And okay, let's look at those two different strategies. Now, the net cost of carrying is the financing cost here, the interest rate. If you buy the asset spots and you need cash today, you have to pay for it. So you have the financing cost. That's interest rate. Now, if the asset is something like coal and you put it on storage, then you have also storage costs. Now, if the asset is something like a share or a bond, then you don't have storage costs, but you may get a return on the asset, a dividend or an interest payment. And so you subtract this. That's explicit yield on the asset. So all assets will actually involve financing costs, but some commodities can involve storage costs, and maybe some financial assets give you actually a dividend yield or an interest yield, which you subtract. And together you get here the entire cost of carry. Now, with both strategies, you will have the asset at the future time t. And because both those two strategies are equivalent, the costs should be the same. It's again an arbitrage argument. People just do what's cheaper. And if they do it, then in the end, we have this condition here. And you can compare this with 36. We have our old arbitrage condition. You see F equals S times E. Now here, so only cost of carry I considered here was actually the financing cost, the interest rate. And now here I'm a little bit more realistic. So we also consider the possible storage costs and possible returns on the asset. And so here, instead of the interest rate, we have is a complete cost of carry here up in the power. And we get back the old arbitrage condition. The argument is actually quite neat, and arguments like this are very typical in finance. You see, the two ways of doing it are actually equivalent, and so therefore, in the end, you just have the asset, and therefore they should cost the same. Any difference in price cannot persist because people will just do the cheaper, and that then will drive up that price. Now, if you go a bit further here, a so-called consumption asset also includes a convenience yield. That's not like a dividend. This convenience yield, okay, I just will show it on the next slide. We also can subtract this convenience yield. You see, in the cost of carry, we already have possible dividends, but then on top of this, there may be this convenience yield here. And you see, really, the two strategies are not completely the same. For example, an electrical utility may have a forward contract. It may hold a forward contract on coal, so it will get the coal in the future, but it only gets it if the coal miners are not on strike. So it's not exactly equivalent. There is an advantage of owning an asset physically, of buying spot and carrying it, instead of just owning a forward contract. If you just have a forward contract on it, maybe the counterparty does not honor the contract. For example, maybe this utility doesn't get the coal because the coal miners are on strike, or maybe the railroads are on strike, or something else happens. So it's really not completely equivalent. So it's convenient to have the asset on storage, to buy it and don't have it in storage. And that's what we capture by this convenience yield. On an investment asset, there is no convenience yield. Then you speak about the pure investment asset. That's not an asset that you use in production. You just buy it for pure investment. So for example, gold is mostly bought just as an investment. So there is no convenience yield here involved. But coal is naturally bought for consumption. So people use it, in factories, it's burned. So here, coal will have a consumption, will have a convenience yield. It's a matter of degree. Naturally, also gold is used up a bit, in jewelry and in electronics. So here, there may be also a small convenience yield. But gold is mostly held as an investment asset, and the coal is almost completely held just as a consumption asset. Now let's finish this up with futures contracts. Now, a future contract is basically a standardized forward contract. It's like a forward contract. Now, forward contracts are so-called traded over the counter. This means an over-the-counter trade is when people know each other. The seller and the buyer know each other. It refers to what happened 100 years ago. You see, 100 years ago, when you bought a share or something like that, you went to the broker. You know the broker knows you. So the buyer and the seller, they know each other, and that's an over-the-counter trade. You go to the broker, you go to the teller of the broker, you go to this desk, so it's the desk, it's also called the counter. Or you go to a bank, a financial institution, you go to the teller, and then over the desk, over the counter, you trade those securities. So with over-the-counter trades, the two parties know each other. So that makes it more secure. You see, you don't deal with crooks. You know whether as a counterparty, as a buyer knows whether a seller has a good reputation, and vice versa. So the people know each other. Now, if you trade at exchanges, at the stock exchange, Wall Street, for example, you don't know the counterparty. So because you don't know the counterparty, you're not so certain, okay, are those honest people, are they not honest people, will they honor the contract? That's much more uncertain than here when it's based on a personal relationship. So exchanges require additional safeguards because the trades are anonymously. Buyers and sellers do not know each other. And in futures contracts, we have the following safeguards that reduce this counterparty risk. So at the beginning of the contract, at time small t, each party has to maintain, has to pay money into so-called margin account. So that may be about 10% of the nominal value of the contract, the nominal of the delivery price multiplied by the number of contracts. So you have to maintain this margin account. And so at the end of each business day, the value of the future contract is reset equal to 0 by crediting and debiting the change in value that occurred during the day to the margin account. So if you are the holder of the contract and the contract increase in value, then this increase in value will be put into your margin account. And if the contract decreased in value, then actually this money will be taken out, it will be subtracted from your margin account. And if over a few days you have always negative movements, and money is taken out from your margin account, then in the end you run out, the account falls to 0, and you will get the so-called margin call. And you have to provide new money into the account. So you can say a futures contract is settled incrementally by daily cash flows between the margin accounts of both parties. When the price of the contract falls, then the value in your margin account will be reduced. When it increases the price, it will be increased. That happens from day to day to day. So we don't wait until the end when the contract expires and have a huge cash flow. We have those much smaller daily cash flows, and that actually makes it more secure. So in futures exchanges, we have additional safeguards because the parties do not know each other. Futures are forward contracts, which are, let's say, are standardized forward contracts, which are traded at futures exchanges, and they involve those margin accounts and those small daily settlements. A forward contract is traded over the counter, and here the parties know each other. So the parties know whether the counterparty has a good reputation. So the risk is lower. Okay, so that finishes the lecture for today. Thank you.